Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. US Treasuries rally with the Fed sounding less hawkish than traders feared. Jerome Powell downplaying the possibility of rate hikes amid fresh concerns about inflation.
The yen surges 3% in minutes, fueling speculation that Japanese authorities intervened for a second time this week.
And chipmaker Qualcomm gives an upbeat sales and profit forecast for the current quarter, suggesting demand for smartphones is increasing.
Well, on the topic of watching inflation more globally, this is a picture when it comes to South Korea's April inflation numbers. Consumer prices unchanged month on month. The estimate was for a slight pickup of just 0.1%. If you strip out food and volatile energy costs, we're seeing a rise of 2.3% year on year. Consumer prices, when it comes to that year on year reading, 2.9%, a little bit softer than expectations of a gain of 3%. And this, of course, sort of marginal in terms of the implications for the Bank of Korea in terms of its rate trajectory. We have really seen a lot of that demand coming through from exports and chip exports in particular, just brightening the growth picture there. But that inflation number for South Korea is slowing more than expected. A pretty reassuring indication that the Bank of Korea is making progress on that campaign to cool price growth. So it could, in fact, put the BOK towards that consideration of a policy pivot at some point later in this year. But at this point, it doesn't look like a major shift will be forthcoming or imminent at this point. Imminent is the market opens across the region. Of course, we have a number of markets coming back online, including Chinese markets after the Labour market holiday, I should say, on May 1st. We are seeing a pretty muted picture when it comes to the setup for Sydney. Futures down by just about 0.1%. We're seeing Kiwi stocks looking a little bit softer at this point. Nikkei futures are unchanged at the moment. Of course, a firm focus on what we're seeing with the yen. Of course, that big move prompting again speculation that potentially there was some an intervention move there, although we have seen, again, a fairly muted reaction from Japanese authorities, kind of saying that they have nothing to say on whether or not they intervened on the yen, Bell.
Yeah, keeping pretty quiet on that one for now. But we'll, of course, find out in due course on whether they did intervene or not. But just to note as well, we had the HKMA coming out just now saying it's kept its base rate unchanged at 5.75%. Not surprising, of course, given the HKMA does follow the Fed. But the market reaction today very much reflected the post-Fed decision or pressure in bond moves, because we had a big move across the board, yields really dropping in tandem. You saw the 2-year yield, for instance, below that 5% mark. And actually, at one point in the session, we had markets headed for their biggest cross-asset surge on a Fed day this year. The move sort of did abate a little bit throughout the session, though, into the close, given we had those chip makers really dragging here, the likes of AMD, Supermicro as well, selling off after their numbers coming out. Not enough to impress investors. So today you do see Qualcomm, again, perhaps helping the picture in after hours with its earnings. But broadly, we do have equities pointing to some slight gains here. Oil as well, just fairly flat at this point of time, around $79 a barrel. Still, though, the broad read-through, Jay Powell not as hawkish as feared, and actually perhaps help to allay any sort of investor concerns that the next move could be a hike and tighter policy perhaps on the way. Take a listen.
I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer. I think it's unlikely that the next policy rate move will be a hike.
Let's get some more insights from the former Dallas Fed President, Robert Kaplan. Robert, always great to have you with us on the day after Fed decision day, of course. Did you think, first and foremost, that the communication side, the messaging, did Jay Powell strike the right balance?
Yes, I think he did. He wanted to make clear that the bar is very high, and it is very unlikely that they're going to be thinking about a rate hike, that the next move is more likely to be a cut. However, he made clear that they're disappointed with the progress that's been made, and they're going to be patient. And I think he did a good job leaving their options open, but reducing the fear that the next move might be a hike. So I thought his communication was right on the money.
The aspect of persuasive evidence that he would want to see before any such move towards tightening is taken, that's interesting because I do wonder what that sort of evidence would look like given this conflict that you continue to see in this, mixed bag of an economy where you've got historically restrictive rate settings versus relatively still easy fiscal and stimulative effect of other settings. Do you think the Fed can do more to address that dichotomy?
I think they've done what they can, and I think you highlighted the issue, the tension. Monetary policy is historically restrictive. We've had dramatic increases. I think Jay Powell reiterated today he thinks policy is restrictive. But you've got still substantial fiscal policy. We're running over 7% deficit so far this year as a percentage of GDP in the United States. That's historically high for an economy that's in full employment. And that spending is coming from unspent American Rescue Act money, Inflation Reduction Act projects, Infrastructure Act projects. And it's particularly affecting service sector inflation and stickiness of wages in the service sector. And I think that's one of the things that make the United States unique versus the rest of the world. The rest of the world didn't have the level of fiscal stimulus that the United States had and still has. And also the United States is more of a service sector economy versus a goods economy. And I think those are both challenges for the Fed.
And do you see that challenge really persisting or perhaps even worsening, given that we are in an election year?
It might. We really have not seen, we've seen good progress over the last year in inflation, but it's a little bit stalled out on the service sector side. And the reason is the employment market is still still tight. Not as tight as it was a year ago, but it's still tight. And this government spending is fueling infrastructure projects, new manufacturing projects that increase the demand for labor. At the same time, the Fed is trying to cool demand for labor. And so, no, I don't see any prospect this year, at least, that tension is going to abate. And that's why the Fed is going to have to be patient. And what Jay Powell is communicating today rightly is people should expect that it may be several months that they're going to wait before they can take action. And he's not putting any timetable on when they might act. And this tension is why.
We are seeing some signs perhaps coming through of a consumer slowdown, for instance, some signals in McDonald's or Starbucks earnings. Do you see the inflation challenge? I can see perhaps it's really hitting a certain pocket of workers that are perhaps on the lower end of the income spectrum.
It is. So it's not that monetary policy isn't working. It's working. It is meaningfully affecting any industry that is sensitive to interest rates. In addition, to your point, the inflation issue particularly affects workers that make $50,000 a year or less. And in the United States, that's at least 60 million workers. That's a substantial segment of the society. And this is why, as you point out, we see same-store sales at Starbucks are weaker. We're seeing weakness and indicative of a consumer that's spending but is needing to make tough trade-off choices and more likely to say go to a McDonald's than to a Starbucks because they get more value for their money there. And they're making very tough trade-off choices about how they're spending. So there's evidence of weakness, and this is very much a mixed bag economy. But the government spending spigot is insensitive to rates, and it also continues to march on and stimulating demand for labor. So, you know, the Great Recession of 08-09 was a crisis of the unemployed. The situation we're facing now is a challenge, not that we don't have enough jobs, it's that people are employed, but they're struggling to make ends meet. That's the issue, and it's particularly the case among low, moderate income workers.
We've talked a little bit about the effectiveness of the dot plot, and I know you're generally positive in the way that that's being used to convey expectations. Do you think, though, given we've seen outsized and some would say perhaps incorrect reactions from the markets, that it is still a useful tool?
So the dot plot is useful as far as it goes, but people have to remember it's a snapshot. It's got basically a one-day useful life. The Fed makes pronouncements, say, in March, but a week or two later, they can change their mind based on how the economy develops. I think that probably the issue that the Fed might want to take back is after the December meeting, there was a dot plot that called for 3 rate cuts, was the median, but the rhetoric and the way it was positioned in the press conference was probably a little more encouraging than they might have liked in hindsight. And they gave the market the sense that it would be at least 3 and maybe it could be 5 or 6. And financial conditions eased probably more than they would have liked. So you see now they're going to be very, very careful not to give any false hope to the market and not do anything that unduly eases financial conditions as we go through this inflation battle.
We talked about some of the domestic inflation risk being an election year, and I wonder about some of the external risks because, of course, a component of that goods picture is also disinflation from China. Do you see that being a big aspect of where we see impact and an ongoing one, particularly in the light of the overcapacity issues?
Yeah, so there's 2 big aspects to inflation. There's goods and there's services. Goods are actually disinflating, and I think the Fed has made very good progress and sees very good progress on goods disinflation. And to your point, China overcapacity is a big part of that, where China is exporting disinflation because they got so much overcapacity in goods. The issue in the United States is in the service sector. And that's really ground zero of this challenge. I think the goods sector, given global overcapacity, is actually now back under not perfect, but under pretty good control.
That was Robert Kaplan there, former Dallas Fed president and co-chairman of the Draper Richards Kaplan Foundation. Thanks so much for your insights and your time this morning. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go on their terminals. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. This is Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected.
That was the Fed Chair, Jay Powell, signaling fresh concerns about inflation. And, of course, one of the assets that we've seen most reactive to that rate differential between the Fed has been the Japanese yen, and those moves really reflecting as well Japanese government policy. But that sharp move there that you're seeing for the local currency, the Japanese yen, over 3% surge in the final minutes of New York trading, fueling speculation perhaps. So we've seen further intervention from Japanese officials. But let's bring in our executive editor for Asia markets, Paul Dobson. And Paul, yeah, I guess we don't have any clarity, at least, on whether it was intervention or not, but it has the hallmarks, perhaps, do you think?
Yeah, morning, Annabelle. Yes, the Japanese officials are declining to comment, as is their wont. And yet, from the way that the market moved and the timing and the big jump in volume that we saw at that time, there's certainly a strong suspicion that it's a second round of intervention by the MOF and BOJ to strengthen the yen. And it makes a lot of sense. Wait until the Fed's done, wait until Powell's out of the way, wait until the market is in a slightly less liquid moment, and then go hard and see if you can jolt the market a little bit, see if you can deter those speculators from having large short yen positions and get more bang for your buck that way. So that's what we saw with a pretty rapid and extreme move again, and the market probably expects that we'll continue to see this if the currency traders push the yen weaker again in coming days.
We saw the rates relief, right, in that post-Fed rally for treasuries. I do wonder how sustainable this is. We're already sort of looking forward to what the next lot of data, the jobs numbers, will hold.
The treasuries did manage to see some positives from Powell. He did downplay the risk of a hike, and also the Fed announced that it's going to slow down the runoff of its bond holdings. So it's going to slow down the pace of quantitative tightening, both of which are good news for the bond market. You're right, though, Heidi, we're pricing in that higher for longer scenario. The economy still looks strong. The Fed admitted as much. They said, inflation, OK, so we're having some impact, but not as much as we would like. The market is still only pricing one Fed cut for this year. And there is still that risk that bond yields could move higher again. I think it would be interesting to see how that calculus plays out. People were concerned about increase in supply. We're not really getting that based on the quarterly refunding announcements. So that's one more positive. So a few on the supply and demand side, a few positives there. But probably the more important factor is still the economic data. And if we continue to see inflation surprising to the upside, then yes, that's a big risk still for the bonds market.
What about for equities as well, Paul? Because in the final few minutes of the session, we really saw chip stocks slumping, the likes of AMD, Supermicro. We've got Qualcomm that's moving after hours. What's sort of becoming the more important dynamic for markets now, earnings, or is it still very much the direction of Fed policy?
Yeah, well, the Fed impact didn't last very long at all, did it? If you look at the equities, a bit of a rally, but all of that unraveled again by the end of the day. So the Powell impact on equities, at least, seems to be pretty fleeting. And that's because people are really delving into the earnings, which have been quite mixed. Some big positives, some big negatives. The market has been punishing the underperformers. Today, Qualcomm was a good one after hours, but a couple of the other digital names got hammered pretty badly as well. So there's still that kind of sifting through everything to try to figure it out. It feels a bit more beneficial for stock pickers when you think about it that way. I think overall, as long as the economy is looking strong and as long as the Fed continues to suggest that it's still minded to cut, not hike at some point in the future, the market probably thinks that that's good enough. So equities, once we get through this earnings rally, may turn back to the data and Fed policy and think, well, everything is still looking pretty good. Global growth is looking a little bit more productive and supportive as well. And so it's difficult to turn too bearish on the stock market still at this point.
Our Executive Editor for Asian Markets, Paul Dobson. We do have much more to come on Daybreak Australia as we continue to watch for a bit of a sigh of relief more broadly for Asian FX, given the less hawkish than expected sentiment out of Jay Powell and the Fed after that FOMC meeting concluded. But we do see still quite a bit of strength when it comes to that picture for dollar yen. And in fact, with the yen advancing more than 3% in the latest part of the session in New York, we did see some speculation that Japanese officials had intervened again. So continuing to watch the Japanese currency very closely. Will we see 150 or 160 first after this? This is Bloomberg.
You're watching Daybreak Australia, taking a look at some of the big moves intraday on Wall Street. Of course, we had that rally following the Fed decision, the press really giving some relief to investors. It didn't last too long, though, and this is really why we saw that chip stock slide, the likes of AMD, Supermicro coming out with some numbers that didn't impress investors enough, but really the expectations were sky high because both of those companies still said that they had higher expectations for the quarters ahead. Qualcomm, though, it's a bit of a different story here because we're actually seeing shares that are jumping in late trade, and that's after it gave an upbeat forecast for sales and profits this quarter. Its outlook as well suggesting the demand for smartphones is starting to bounce back. So let's get to our Bloomberg Intelligence Senior Semiconductor Analyst, Kunjan Sabani. And Kunjan, what stood out to you really from the Qualcomm numbers in particular?
Well, the story was while everyone else, its peers, namely Skyworks and Qorvo, are reporting significantly weaker outlooks, and we have also seen the data that the smartphone demand overall has sort of taken a pause. Here you have one company which came in slightly above consensus, which in a way is a win for them. Two reasons driving that. One, we have seen Apple lose significant share in China, and that has been picked up by other Android OEMs. So Qualcomm has a pretty large exposure when it comes to premium Android smartphones in China. So that helps Qualcomm specifically a lot while everyone else suffers through that. And second is most high-end Android OEMs have launched their latest on-device AI phones sort of late last year to early this year. So that has the Snapdragon 8 Gen 3 chipset, which has higher ASPs. So that also helps them with a richer mix while most of its peers, like I said, are suffering through this market.
What are we seeing particularly when it comes to China? Because they've really defended the sense of confidence, right, that they're not seeing across weakness when it comes to the Android segment.
Yeah, so there's like different, in China, you have to look at different, like the mid-tier, the high-end tier. From their commentary, it seems the flagship phones are not seeing the similar weakness that the mass market and the rest of the market globally is seeing. And so that is where they really play, and it helps them. And like I said, the weakness in China was predominantly for Apple. So that is, again, a better deal for them because for every Android handset that sells at the cost of Apple, Qualcomm gets somewhere between 3 to 5x revenue uplift for a device-to-device level.
And Kunjan, just briefly, you mentioned that Qualcomm was sort of standing out from the rest of the pack. AMD was one, as I mentioned, had a big slide intraday. It seems like there's a bit of concern around the AI chip forecast.
Yeah, it's more than the concern. I mean, fundamentally, the story remains intact. It was that coming into the earnings, buy-side and investors had some really lofty and aggressive expectations, which they were not able to beat. And for a high-flying AI name like this, you really, and the precedent that NVIDIA has set, like every quarter, people just expect really high beats and raises, which didn't happen. The other fact there is, if you look at the rest of the non-AI business, it's really going through a slump, sort of offsetting almost all of the AI goodness. So at a company level, actually, the EPS numbers were brought down a bit for 24 and 25.
There, our Bloomberg Intelligence Senior Semi Analyst.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. It is likely that gaining such greater confidence will take longer than previously expected. I think it's unlikely that the next policy rate move will be a hike. I do think it's clear that policy is restrictive, and we believe over time it will be sufficiently restrictive. I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope. See if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. We just don't go down that road. If you go down that road, where do you stop?
That was the Fed Reserve Chair Jerome Powell there speaking at the press conference following the Fed decision, keeping rates on hold, but importantly signalling that still the next move likely to be a cut, perhaps not this year, but still a cut, a hike, not on the horizon for now. And so that really was reflected in the moves, particularly in the bond space. We saw a big rally across the board, yields dropping. The two-year yield, for instance, there, we actually saw it dropping below 5% overnight. But again, you're just seeing that slight retreat building through in the Antipodean so far, the Aussie 3-year, the Kiwi 2-year as well. Let's bring in our next guest, though. Pooja Malik is partner in Nippon Capital. And Pooja, walk us through your reaction to the decision here. Not quite as hawkish as has been expected, but it does at least be providing a little bit of short-term relief to investors.
Yes, I think the Fed did exactly what was expected in terms of leaving interest rates unchanged. The positive sign here was that the quantitative tightening, they backed away from that a little bit. And I think that's a positive to the market. The other big signal from the Fed was that they don't see stagflation. They don't think there is any possibility of a rate hike in the near future, because you could argue with GDP growth looking so strong and inflation remaining stubbornly high, the Fed might be thinking of a rate hike, which they clearly squashed. So I think all in all, it was a positive for the market.
What was interesting, though, was that relief that came through for the market was sort of short-lived, because we had chip stocks, for instance, slumping, and then US equities broadly looking a little weaker with the likes of AMD and Supermicro. What do you think is more important or a key driver at this point, earnings or what Jay Powell does?
Earnings are definitely the most important driver, unless the Fed makes a very extreme move in either direction. Right now, the Fed is staying balanced and watching for data on inflation, data on employment. And I think if they were to shock the market, then yes, the market would be dependent on Fed moves. But as long as they stay within these sort of broadly defined guardrails and keep following the data, the earnings are going to matter. And that's what you saw after the close also, as the semi-earnings came in, and that was the conversation you were having earlier. If you look at the Magnificent Seven in the US, which have been up 60% in the last 12 months, that's largely been driven by earnings growth of more than 40%. So earnings definitely are driving markets at this point.
When do we start to see a deeper impact when it comes to higher for longer in those earnings, right? Because we already see that big sort of chasm within the broader economy between goods and services and the aspects that are benefiting and those that are not. Do you expect to see that playing through more through to corporates?
There's definitely a bifurcation we're seeing, Heidi. If you look at consumer-based stocks, whether it was Starbucks or McDonald's, missing earnings, pointing to a consumer slowdown, there is that bifurcation between corporates, and especially those driven by exports, still doing well, versus consumer. And that's the other thing that Fed alluded to. They did talk about inflation impacting consumers and those that can least afford it. So that's something that I think the Fed is very centered on, looking for employment numbers, looking for continued inflation signs that the common person on the street is getting impacted.
Across this earnings, obviously, particularly for chip makers and big tech, the returns from the buoyancy of the AI trade continue to pay off, right? How sustained do you expect to be, particularly in a more difficult funding environment? And what's the next leg, I guess, the next part of this rally?
Yeah, I think the earnings growth will still be there, Heidi, but not to the same extent as we saw last year. So last year, the Magnificent Seven grew earnings 40%. This year, I think expectation is at 20%. The interesting thing we're seeing across emerging markets, for example, in the Taiwan and Korea supply chain, is that many of the mid-cap companies that were supplying originally to PC makers, phone makers, are now shifting to support the growth in server demand. And so we're seeing businesses pivot to take advantage of this AI technology trend. And that's where we're seeing the next leg up in terms of those sets of stocks doing well that are shifting their end user base from commodity type devices to more server and AI type devices.
What about expectations around China's equities market? Because, again, their earnings perhaps a bit better than expected, and we're seeing signs of stabilization. Is this a point to be getting in, do you think?
It's been a long time coming, right, in China? But yes, we're finally seeing signs of some growth. GDP growth for Q1 is still likely to come in over 5%. And the more interesting thing is we're seeing both the consumer recovery as well as the manufacturing recovery. So both things moving in tandem we haven't seen in a long time. The property sector still remains troubled, and I think that's going to be a long and slow recovery process. But besides that, the government is supporting the economy, the government is supporting the markets. And so we're finally seeing signs of a recovery in China. And in April, the Chinese equity markets were amongst the best performing in the world, outperforming broad EM as well as US.
Yeah, the EM trade is an interesting one at the moment, right? Do you see the pickup in growth in China or the uncertainty there having a bigger correlation, or is this really down to perhaps we see a bit of a calming of the US dollar and that's going to more broadly benefit emerging markets?
I think China itself is largely decoupled from the US and the Fed interest rate decision. And then when you think about broad emerging markets, there are segments in EM like Latin America that are very sensitive to the Fed rates, or currencies, for example, in India and in Korea that are sensitive to the US Fed rates. But China is slowly emerging back as a significant support for EM. And, as we've talked about in the past, the Middle East and domestic growth in the Middle East is another sort of positive for EM. So I think we continue to see broad divergence within the EM space between rate-sensitive assets and more domestically oriented assets.
Rate differentials, of course, one of the key assets that's been impacted by that is the Japanese yen, with the big gap between the BOJ and what the Fed does, which has, of course, really played out in what we see for trading around the Japanese currency as well. How long do you see that weakness persisting, or how effective do you think intervention could be, if indeed we have seen it a couple of times over the course of this week?
I think that the issue in Japan is that, inflation is not really a near-term issue, and some amount of inflation would not be bad for their economy, right? But again, it comes down to the political interest versus sort of the financial interest, which is that for the government, for the Ministry of Finance, inflation is a problem because it's disproportionately impacting small businesses and consumers, even though a weaker yen is a positive for big companies, for exporters, right? And so it's that disconnect that's leading to the inflation, where the Bank of Japan is almost okay with the weakness in the yen versus the government, which is the Ministry of Finance, would like some stability in the yen, and that's why we're seeing the interventions. To your question of can the interventions have an impact? I think the impact is temporary because eventually market forces are driving the yen weaker, and the interest rate, as long as interest rates in the US stay high, it's hard for the yen to become stronger.
Pooja, really great to have you with us. Pooja Malik, partner at Nippon Capital. Let's take a look at the setup as we're just about 20 minutes away from the start of cash trading here in Sydney, and also the open in Korea and Japan as well. Sydney futures looking pretty muted at this point, looking like we'll actually extend the losses that we saw in the previous session, a pretty broad-based sell-off that we saw on Wednesday, and we're not getting much of a relief rally being set up at the moment. We are looking at a bit of a decline of about 0.1% when we first start to get to the start of trading, as we did see US equities falling, reversing that afternoon rally. Chip makers, energy stocks, and in particular for Australia, we'll be watching the path through to energy names as well. Nikkei futures also looking pretty muted, despite, of course, the big move that we did see in the yen, which generated a lot of speculation that perhaps another bout of intervention was what was behind that. This, as we continue to watch Asian markets react, with the Fed holding rates for a sixth straight meeting, less hawkish than expected tone being delivered by Fed Chair Powell. More ahead on Daybreak Australia. This is Bloomberg.
You're watching Daybreak Australia, the latest in geopolitics. And New York police arrested almost 300 people, breaking up escalating protests over the Israel-Hamas war at two colleges. The arrests were made at Columbia University and City College of New York. Police officials say outside agitators had joined the Columbia protests, but are still determining how many non-students were arrested. Bloomberg has learned that the US and Saudi Arabia are closing in on a historic pact offering the kingdom security guarantees and a path to diplomatic ties with Israel. Sources say officials are optimistic a deal can be reached within weeks, but obstacles remain. Israel is expected to be offered a choice to join the deal dependent on ending the Gaza war and agreeing to a path toward Palestinian statehood.
Taking a look at what we're tracking when it comes to commodities, and we're continuing to watch oil as that energy really continues to hold the slump. US stockpiles are surging, highlighting some of the concerns on the demand side. We've been focusing so much on the geopolitical aspect, of course, but we have seen stockpiles jumping 7.27 million barrels in the US last week. That's the most since early February. We've seen that decline of more than 5% for crude prices this week after last month soaring to the highest since October. We're still watching some of those geopolitical developments and the prospects of a historic ceasefire impact as well when it comes to the oil front. A little bit of upside this morning when it comes to trading in New York crude. Iron ore also seeing a little bit of a lift there as we're watching sort of the reaction play through. We did see a drop prior to the Fed that really hit not just iron ore but across broader base metals. Well, China's top climate chief is set to meet with his US counterpart in person for the first time next month. Speaking exclusively with Bloomberg's Stephen Angle, Liu Zhenmin says he also sees common ground for the US and China to cooperate on climate issues.
I shall bring a delegation from different ministries looking after different issues. I think we are looking forward to have a very sincere and practical conversation with our U.S. counterparts to start the cooperation in some areas.
How do you see in the United States, they've had a changing of the guard as well, Mr. Podesta, how do you see that relationship building?
Between China and the United States, we had relatively good cooperation ever since the last 30 years for the climate change process. Of course, over the 30 years, during the Bush administration and during the Trump administration, U.S. stayed away from the climate process. But on the rest of the years, we had very good collaboration.
Is it even possible to have a separate dialogue, diplomatic dialogue on climate? Because there are a lot of other very contentious issues that are clouding the U.S.-China relationship. Is it possible, or would you rather see a more dedicated climate dialogue in separation from, say, the other issues that, whether it's the South China Sea or geopolitical relations, and that's really clouded and deteriorated the U.S.-China relationship?
China-U.S. relationship is really very complicated. But I think for climate change, both China and U.S. has a common but differential responsibility, and we have to cooperate and as far as possible to continue to lead the global process.
What happens if Donald Trump is reelected? What's your view?
That's one of the worry in this climate change community. I definitely hope that the American people will support the government to stay in the climate change process, stay in the Paris Agreement, even Trump wins the next election.
In March at the Boao Forum, you said protectionism and economic competition are becoming another problem for the global fight to combat climate change. How much is this holding back the global fight for climate change?
When I mentioned that issue, I think I'm focusing on the impact. If this protectionism, unilateral measures, these non-trade tariffs, will definitely, if our partners, North America and the European partners continue to follow this practice, not to talk about trade, it will impact the global process. If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion US dollars. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody's going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. colleagues, European colleagues, going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade,
we can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'd be also good that be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
That was China's Special Envoy for Climate Change, Liu Zhemin, speaking exclusively with our Chief North Asia correspondent, Stephen Engel, in Beijing. And you can watch us live and see our past interviews on our interactive TV function, TV Go, that you can also dive into any of the securities or Bloomberg functions that we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
Well, as we mentioned earlier, National Australia Bank has announced a further $1.5 billion Australian dollar share buyback as its first half earnings broadly met estimates. Paul Allen has more analysis with us. And Paul, a lot of that focus was on the capital management plan.
Yeah, and the buyback itself was widely anticipated. Analysts have been discussing it in the days prior, and we weren't disappointed. We also got an interim dividend of 84 cents per share, and this is a theme we're expecting to see repeat with other banks next week, returning cash to shareholders. The cash profit, meanwhile, $3.55 billion. Very narrow miss, but a 13% decline on year. That was led by a 30% contraction in personal banking cash profit. The net interest margin also shrank by about 5 basis points, as there's been a lot of competition for mortgages over that period as well, but that's starting to back off also. In terms of commentary, the CEO, Andrew Irvine, sees a resilient outlook for the Australian economy, says the bank, the customers are in good shape. He sees unemployment creeping up, a GDP below trend in Australia. But that mortgage cliff that we were talking about, rising property prices, rising interest rates as well, it never really eventuated, NAB saying that home arrears only slightly higher than this time last year.
And Paul, we're going to be getting the results from the rest of Australia's big banks next week. So how does this sort of set the tone for what's to come, do you think?
Yeah, we've got Macquarie Bank tomorrow, Westpac Monday, ANZ Tuesday, and as I alluded to with Heidi there, we are expected to see this ongoing theme of cash being returned to shareholders. ANZ is expected to announce its first buyback in 2 years. Westpac is potentially seen announcing a special dividend as well. But the banks generally have been doing pretty well in this era of higher rates. Of course, the cash rate here in Australia, 4.35%. Historically, it's pretty high, and we don't see any change from the RBA coming soon with inflation remaining sticky in Australia. NAB stock, that's up 10% year to date, and it's been outperforming the ASX more broadly. But going forward, there's 3 buys, 8 holds, 5 sells for NAB, and Citi has moved all of Australian banks to sell. Macquarie saying that the macro backdrop for banks is about as favourable as it possibly gets. So it's going to be interesting to see how NAB does at the open in just a few minutes' time.
All right, that was Paul Allen there in Sydney, and we're just getting the meeting minutes that are coming through from the BOJ one in March. This was the period where we saw the BOJ raising its short-term interest rates to around 0 to 0.1%. So exiting negative policy settings that had been in place since 2016. What we're hearing or what we're getting from those meeting minutes is essentially that at least one member was saying that they should begin normalisation. The question, of course, is when we're going to see future BOJ rate hikes, but they're also saying that they will be responding to the economic conditions as well. BOJ members likewise saying that financial conditions should stay easy, but that there still are uncertainties regarding the Fed direction, and that's really been what's playing into the Japanese yen dynamic. You can see here, again, you're seeing weakness this morning against the dollar, but late in the New York session, we had as much as a 3% jump in the Japanese currency. The question is whether we saw Japanese government officials intervening into the market. Quick check as well on US futures here. You are just seeing them climbing across the board. Again, an interesting session. We did really see a slide into the close with the likes of AMD and Supermicro slumping. So it was that story of weakness for chip or AI hardware stocks. But we do see Qualcomm here after hours rising, perhaps building into that sentiment. More ahead. This is Bloomberg.